Alright, welcome back. So this is the part 2. Like I said in part 1, I hope you have a pen and paper with you, because in front of you I have an illustrated MMXM. So please take a moment to pause the video and illustrate this into your notes. So I'm going to dissect this and go over everything with you, and of course a lot more. First thing I want to go through is two-stage liquidity. Basically, when you want price to reverse at your POI, you want 2 stages or more of liquidity to be ran through. So here's the thing. You got accumulation here, accumulation here, before expanding down into the POI. So what does accumulation do? Accumulation basically accumulates liquidity. When it goes up, down, in a range, it's accumulation, and it's building up liquidity on both sides. So we can put $ as a representation of liquidity. That's how you want to visualize accumulations. So, before coming down into our POI, it made an accumulation. I want to focus on this one. You always want to focus on the consolidation right next to your POI more. So this is a structural liquidity. Another thing you need to know is IRL and ERL is also liquidity. So this accumulation zone right here is your first stage. When price finally comes into the POI right here, it's your second stage. Now you can expect price to start its buy-side curve. Basically, you want to visualize it like this. It's a little stronger like that. Coming into a FEG. There's your liquidity right here, your first stage. 1 and 2. It's your POI. Until then, you want to let price form. After then, you can start looking for little FEGs going in the direction where you want it to go. This is mostly how you look for, what the heck, sorry. People know this as turtle soup. This is how you frame a turtle soup trade. This can even be inside of a liquidity void or an FEG. The heck. Sorry. Hopefully you understand this and drew it out. And since we know IPTA now, from accumulation, what comes after? An expansion. After an expansion can come a consolidation, or as you can see it, as it's coming into a POI, now it's causing a reversal. But I do want to go back on what I said earlier a couple seconds ago. I don't really see this area right here. Let me highlight it with this. I don't really see this as an accumulation. I see this more as a structure. I'll call these accumulations. Little areas right here, accumulation, but I'll call this a structure. Because after price expands into your POI, it's gonna have to make some type of structure to then make the buy side curve. Oops. Put it right there, yeah? So you can visualize sell side, buy side. As we all know, accumulation, expansion, reversal. Of course, I said earlier, these are both types of liquidity, so it can be like this too. Here's the thing I want to say real quick. Trade what's easier for you to see and what you are accustomed to seeing. If you're able to see ERL to IRL trades a lot easier than IRL to ERL trades, then trade that. Because honestly, trading every movement, IRL, ERL, back and forth, trying to catch every trend, every move. I mean, if you're pretty good at it, you're gonna make a lot of money. But for most people, it's gonna blow your account. Can't be trying to predict every move in the market. Which is why I give the advice in the part 1 to let sell side curve form, make a structure, and then wait for a buy side FEG to form. Just like this. So I'm gonna dissect this model. And go over every little part in this model. And then some. What I really want to start with is the LRLR. This is a pretty important lesson a lot of people don't put into their MMXM courses. So I need to make an illustration for that. So there's two types That's LRLR. That's HRLR. I'm gonna show you the difference. Oh, I also need to tell you what it is, huh? It's a low resistance liquidity run. It's high resistance liquidity run. Let's show you what it looks like on the chart. Well, as an illustration first. Where the heck are the trend lines at? Oh, right here. Let's have our baseline here. Let's say price has been coming down. Makes a higher high. It's a low, a lower high, new low, a lower high, and a low. High resistance. It's going to be the highs being taken. It's going to be a lot uglier. Like that. Here's the difference. Just like I said, ERL has liquidity. So all this liquidity has not been mitigated, has not been rejected or taken. But a lot of liquidity in that high resistance has been taken. What does this mean? This means that when you're trading in a low resistance liquidity run and you're by the buy side curve, it's going to be a lot smoother, a lot more fluid. It's going to go up. On the HRLR, price is still going to go up, but not as pretty as that. It's going to be a little uglier. Something like this, right? Here's my little trick to this. You mostly want to target the failed high. Of course, hold on. You want to target this failed high right here. Why? Because they're trying to target this high. It's going to take longer to get there, and it might not even get there at all. That's the thing. If all this liquidity is being taken from the highs, it might want to just keep doing that, keep going down. But if the liquidity is still there, you can target the high. Take it. Just like in this. The high is taken. So now we know what LRLR is. And you mostly want to look for that in your trades. If you see an HRLR, all you need to do is just go down a little bit on your lot size. Maybe extend your stop loss a little bigger than what you're normally used to. And just let it ride out. With low resistance liquidity run, you can stay on your screen, have a nice stop loss, and make sure it keeps going your way. But with high resistance liquidity run, it's gonna make a little order block, crash through it, stuff like that. It's gonna make an FEG, test it, crash through the FEG, come test the order block. It's gonna mess around a little bit more than this. So now we know what this is. I don't know why it doesn't erase everything. one thing I want to mention is we want accumulation before POI being hit. It's a piece of advice. If you see price just fully crashing down to your POI without making some accumulations, most of the time your POI is going to fail because it's not building up liquidity towards it for it to be ran through in the future. If it's just crashing down, it's only offering one side. It might come back and grab it like a liquidity void or FEG in that expansion all the way down to your POI and just keep going down. And here's the golden rule. When you see consolidation, with the buy under consolidation, accumulation, sell above the consolidation, the consolidation or accumulation. You want to, it's one of the golden rules in trading. Because when you're buying above the consolidation, you're buying expensive. You're buying in a premium, basically. When you're selling under consolidation, accumulation, you're selling in a discount. Selling when you shouldn't be. Because all this price accumulation does, like I said earlier, is build up orders. It's going up, no one's going down. It's going up, no one's going down. That's what everybody's going to be thinking when this is happening. So when you see price come down under a consolidation, what do you think is happening here? Everybody and their mom is selling. And if we know the statistic of, what is it, like 90%, 95, or something about 99% retail traders losing, why do you want to be trading with them? You should be trading against them, right? For the next part, I'm going to go over STDVs, standard deviations. And I'm going to teach you how I use them and how most other people do use them, but they do use them in different ways. But the strongest way to use it is on the manipulation leg. So we have a POI right here, right? Say price coming down. This is your manipulation leg. It's crashing through this low, coming into the POI. Price comes up, creates CISD, retraces, and goes up. You want to grab your fib tool, put it on the low to the high. This manipulation leg. Sorry. That on. I'm going to make this yellow so it's a lot more noticeable. Here's the rules. At -1 standard deviation, you want to be taking profit here, or partials, or move your stop loss to BE. There's different rules to it. You can have your own way of trading, of course. I can't just tell you exactly what to do when you have your own opinions of the market yourself. But if you see a high at the -2, so like this, you want to take profit at the -2. if price is a lot higher than this, the high is up here somewhere, the -2, you can expect consolidation. Keep going up. It might come back down to -1. If you see a nice FEG or an order block around this area right here, the -1 area, it is valid to use. Most of the time, it's going to come to -1 and start consolidating here too. So this STDV is going to be a nice tool to gauge how far the market should go. Because it is a standard deviation of the manipulation leg. So we got that out of the way. Another thing that just came to mind is in your buy side of the curve, you want the bearish PD arrays to fail. Bearish PD arrays fail on buy side curve. It's the next part. And to be reused. It's going to be nice when I talk to you about the CISD. What does this mean? So, most of the time in this expansion leg towards the POI or in the manipulation leg, it's going to be some type of imbalance in there too. Imbalance just means one side was offered more than the other. Obviously here, sell side was offered more than buy, and here too. You want to see price, well in this scenario, rally through a bearish PD array, and then reuse it again, as it did here, and up here. Also another thing to know is you're mostly going to see accumulation in your buy side curve in the same area as accumulation on your sell side curve. This is another nice way to gauge price and expecting it to do something that you've already seen happen before. The most important accumulation is accumulation right before hitting your POI. Most of the time you want to be taking partials here at the high of the accumulation that came in here. Here, it's more probable price will come here, and it's less probable price will come all the way up here. But of course, you have a nice LR, everything's going your way, you have nice beautiful FEGs coming up, then yeah, put your stop loss at BE and let the trade just ride up. So then you talk about this part right here, CISD. CISD is very, very controversial in the trading world. Many people have their different types of CISD, but I'm going to give you my favorite types and the strongest types that I've seen in all my years of trading. So let me draw this out. So your manipulation is where? Here. This is your manipulation leg. In this manipulation leg, you're going to find a type of imbalance. This is called IFBG CISD. I'm sure you guys know what FEG is, but in case you don't, I'm going to give you a quick illustration of what it is. Basically, well, one side of the market is only offered, like here, it's bullish, 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 no sells. This is an imbalance. You want to use the imbalance in the middle. As I said in the part 1, market likes to seek equilibrium. Most you're going to see price come back down, retest it, and go back up, continuing. Not always. It's sometimes going to come down to fill it, and sometimes it's going to come down outside of it, then continue going up. This is why I don't advise putting your stop loss under an FEG like this. I mostly advise entering on FEG, putting your stop loss under the low, the whole thing. A lot safer. And this little part right here, where it comes outside of the FEG, this actually happens a lot. Of course, there are some times where it just taps into the FEG and just shoots up. But more than not, it's going to come down, retest an order block, something in here, keep going up. So that's a normal FEG. In case you don't know what that is, fair value gap. What does this mean? This is the fair value right here. Equilibrium, where buy side is offering, sell side, it's inviting, I want to say. It's inviting sell side to come down. So now buy side and sell side has been offered. Now price can continue going its way. So all an IFBG CISD is, it's called an inverse fair value gap. Because we don't want it to be used as a normal FEG. We want it to be crashed through or rallied through, reused, and continue. This can also be inside of the expansion legs of the sell side curve, just like this. Another variable of this is price using the FEG and then invalidating it. So this is manipulation, right? Manipulation leg. Price may come to test it, reject, not make a new low, go up, retest it, and keep going up. This is where you're going to see a lot more than the illustration before. You're mostly going to see a test, a rally, invalidation of the FEG, and a retestment. You want to be seeing this at your POI. You don't want to be just using this anywhere. Also, you want to be seeing this at your sweet spots. This could be 3 to 4 a.m. right here. Even stronger, 3:30. The next form, I had to use boxes for this one. I call this an order block, CISD. So let's say price came down. Has an order block. So when the retail uses supply and demand, you can expect price to come up, and retest it, and shoot down, right? But we want to see the opposite of them at the POIs and at a specific time. We want to see it be rallied through. So now this little bullish candle here, I'll make it green just to make it even more noticeable. Rallied through, reused, retested, and continue. It's OB CISD. But since I explained what an FEG is, I should probably explain what OB is. OB is order block. Another piece of advice is if you're going to use an order block in your favor, not in this type of scenario, you want to see a turtle suit. So let's say we have a high, a low, higher high, and now here it makes your order block. This is how it's taken, right? And of course, two-stage liquidity, right? So it's coming into a POI. Now you can expect price to retrace to the order block or CISD in this scenario now and be used just like this. These two are the strongest forms of CISD. So where do you want to be seeing these CISDs? Here's the thing. Most people are going to be looking for them right here, right? At the top of a POI. But who's to say, what if it comes down to CE? CE means consequential. Oops. Encroachment. Basically, it just means 50% of the POI. This midline right here is 50% of this box right here. Price could come down here to the CE and then go up, or price can use the bottom of the POI and then do the structure you wanted it to do. That's why you never just put a blind limit order your POI and expect it to do whatever you want it to do. You can't. You need to let that structure form first. Make a CISD and then make an FEG and towards your bias, not against it. So I got this ambulance passing by right here. I'm gonna let it go by real quick. Oh, I don't know. I got a husky, so it's gonna cry really ugly right now, maybe. Okay, he didn't. So now we know what CISD is. And we know what IFG is. Now we need to talk about SMT. A lot of people have this wrong. The SMT. There's two types of SMT. There's correlated SMT and there's inverse SMT. What is SMT? It means smart money technique, or it could be called divergence. So correlated pairs, this is what we want to see. For inverse pairs, this is what you want to see. So basically, let's say that this is gold. I'm gonna give you some sauce right here. I like to correlate gold with XAU CHF. I know most people use silver or the futures version of gold, which is actually wrong. If it's pretty easy to Google the correlation of gold, and you're going to see that XAU CHF has the strongest correlation with gold. So, in my opinion, I have no idea why people use silver. So, when price, two pairs are correlated, they're mostly going to be doing the same thing. But when you see them not do the same thing, as gold made a higher high, but XAU CHF made a lower high, this is a divergence. You want to be looking for this at your POIs. Here's another thing. If gold is making a higher high, this means it's weaker to trade. XAU CHF has made that lower high, right? This means it's stronger. Why? What does this mean? So on gold, the bulls had enough power to make another high. But in XAU CHF, the bulls did not have enough power to make another high. It made a lower high. It failed to make a new high. This means that if you trade XAU CHF, price is going to go a lot smoother towards your objective. But on gold, it's still going to do the same thing. But it's going to take a little longer than XAU CHF. Nonetheless, I still trade gold only, and I'll still trade it even though it's weaker. This SMT is what I'm mostly looking for. Inverse SMT. Basically, you just want to look for the inverse, the opposite. So this can be gold. This could be DXY. And honestly, this is just an example. I know that there are people who use XAUSD and DXY, which in my opinion, again, is terrible. Like I would never. I've already gone through this phase. This inverse correlation doesn't really work. It doesn't really match up when you want it to be matching up. It might work here and there, but honestly, using a correlated pair like this type of SMT is a lot stronger than using an inverse SMT. You might have 3 screens, 1 pair, 2 pair, third pair, 2 pairs correlating, third pair inverse. You can do that, but honestly, that's overkill in my opinion. Just using correlated SMT. Basically, gold made a lower low and then rallied. DXY made a higher high and it crashed. So this is the difference. There are 2 types of SMT. And you have my personal opinions on this. Erase this real quick. So now we understand what turtles are, and now we know what SMT is. I do want to talk about this little middle structure right here first. A little bit more. I'm going to show you another variable you're going to see. Say price came to your POI, right? Most of the time in the fractal time frame, like on a lower time frame, you're going to see this type of structure. You're going to see price come down, use the FEG, come down again, use FEG, not make another low, go up, retrace. This is what most people think. It's gonna keep going up. But what I teach my students is that this is a FOMO move. Because if you have an expectation that it's just gonna retest and keep going up, what are you gonna do? You're gonna buy above a high and put your stop loss over down here. And then it's gonna crash. And you're gonna be like, no, why did he teach me this? It doesn't work. No, you should never, ever, ever buy above a high and never buy while it's expanding. More than likely, it's gonna make this little high. I call this little move right here. This little move. Suspension leg right here. I call that the FOMO. This decline right here, I call this sharp decline. Because now you have liquidity being ran, which is another form of turtle soup. And yes, you can look for SMT here too. So yes, exactly. SMT can be used on both sides of the curve. Is this the only place we're going to look for SMT? No. Because you're going to look for SMT right here on this buy side of the curve and this FEG. You're also going to look for it right here too. This is going to have some type of SMT also. Always look for it. Here, I'm going to write that down. Oh, the heck. Always look for SMT in POIs. Even when price is already going your way. What do I say this last part? Even when price is going your way? Because what if it makes another type of SMT against you, right? Or if it's going up and there's an SMT appear, now you're gonna expect price to crash down. So you always want to be looking for this SMT. Have your two charts open and make sure that everything's going how it's supposed to be going. If it makes an SMT against you and you're expecting a bullish price action, then this is not a good sign for you. Price is gonna make that little double top and boom, crash right through this. So this is not what we want. So always look for SMT, guys. This is how you confirm. This is how you validate your setup, your trade. If there's no SMT and there's no good time for you to be trading it, then don't even trade. Remember, in trading, less is more. Never forget that. Less is more in trading. Because if you're the type of person to take 50 trades a week, I'm mostly gonna look at you and think he doesn't even know what he's doing. Honestly, in all my years of trading, whenever I hear people tell me they trade 20 trades a week, I'm like, oh no, what is he doing? I like to trade like once, or honestly, like 1 to 3 a week. And I'm gonna tell you why right now. Because one topic most gurus, I would say, or wannabe mentors, they don't touch up on is red news. Hold on, let me finish this illustration here. I'm sorry, I'm going off topic. After this sharp decline, you're gonna have SMT, and now you look for price to go your way. So for this lesson, this little part, don't buy here ever, 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 ever. Let price have a sharp decline first. Let it, and then you can buy it. I know this is bullish price. You're gonna be like, oh shit, it's going without me. Honestly, if we wait like another hour or two, it's gonna come back down. The market does this a lot, a lot. So now we're to talk about red news. This is gonna be the most valuable part of this part 2 video. I'm gonna write that down. Most valuable. I'm gonna give you some sauce here. So here's some scenarios. Well, first I want to say you do want to have your Forex Factory calendar open and looking at the current week and everything. So this next week's gonna be 7th and onward. I should be putting it on here actually. On Sunday. Look for the red news. Filter, take all these out. Your red news. And look for USD if you want to be trading gold like I do. So, let's say you have a POI, right? What the heck? So like this. I'll do another illustration here. So, if you see a red news, I'm gonna put it here at this high, structural high. You see the red news go through a high like this into a POI. It's your FEG. Most likely, price is gonna reverse. Because what is news? News is manipulation. It's straight up manipulation. At 8:30, most red news at 8:30 it's going to be manipulation. This is why I had my sweet spot in part 1 at 9 to 10 for New York session, because it's after most 8:30 red news. Most. There's some at 10, there's some at even in the evening. So you have to keep your eye out, of course. So we'll do the same illustration. What if price did it before the red news? Now you can expect the red news to be the distribution in this scenario. See the difference? The high, this two-stage liquidity was hit before the red news, so the red news is going to do what follows after. The red news here was part of this two-stage liquidity, and actually it's even stronger in this scenario because most red news, I'm not sure if other people use this term, but I like to use the term recovered. Because red news is really a liquidity void. Like, it was a news that pushed the market, and of course the market does what? It seeks equilibrium. It seeks buy side and sell side offers. So most of the time, the red news is going to be filled. Just like in this scenario, most of the time it's going to come back up. Used as a liquidity void or FEG to continue. In this scenario, most of the time it's going to come crashing right through it. So this is the best way to look at red news. So you always want to let the red news happen. Never trade during or before. Why don't you want to trade before? Because if you're trading something volatile like gold, like I do, most of the time you're going to be seeing accumulation the whole day. Like if it's NFP, probably the whole week. The whole week's going to be accumulation, and then around NFP is going to do the big moves, the big volatile moves. So you never want to be trading before. Trading before red news is amateur. You don't ever want to. You want to be professional, right? You want to do this for a living, right? You need to do it right. Alright, so it's going to be the end of part 2, and I hope you learned something very valuable here. Thank you for watching.